Bonds are a staple investment asset of any portfolio, but for many investors, they remain somewhat of a mystery. So today, we're going to take you through how bonds work and some of the ways that you can invest in them. For this video, we've partnered with FIG Securities. FIG is one of Australia's leading fixed income specialists. For 25 years, they've been helping Australians invest in bonds and manage their portfolios. With FIG, you can start investing in bonds today. Before we get started, you should know that this is not financial advice. If unsure, make sure you seek professional guidance before making a decision. So what is a bond exactly? A bond is like a loan. When you buy a bond, you're lending money to the issuer of the bond. You receive regular interest or coupon payments over the life of the loan, with the principal amount repaid at maturity. In other words, when the contract comes to a close. So you recoup your original investment amount and you receive an income along the way. Unlike a typical loan, some bonds can also be traded. This means that it can be bought or sold prior to the end of the term. The idea being that it gives investors extra liquidity and the potential to make a capital gain. So why do people invest in bonds? Well, bonds are popular because they provide a predictable income stream, portfolio diversification, and secure capital. Bonds also tend to be less volatile and risky than shares and many other investment classes. Historically, returns aren't as high as shares due to the lower risk. They offer regular defined coupon payments, whereas shares, for example, are not guaranteed to pay dividends. When the RBA cash rate is higher, the coupon rates on floating rate bonds can see an uptick too. During early 2022, investment-grade returns on bonds were in the 3% range. But at the time of filming, investment-grade bonds are returning more than 6%. That said, like any investment, there is still risk involved. If the issuer of the bonds becomes insolvent, you may lose some or all of your initial investment. The risk of this happening is typically measured by the bond's credit rating. For instance, investment-grade bonds have extremely low rates of default. But, as with any investment, make sure you seek professional advice before you get started. In Australia, investors can choose from government, semi-government, and corporate bonds, as well as non-AUD denominated bonds. As their name suggests, Australian government bonds are issued by the Australian government. They're considered low risk and therefore offer lower interest rates on the market. Semi-government bonds simply refer to bonds that are issued by state and territory governments. Corporate bonds are generally more diverse, and they can offer a higher return. Within government and corporate bonds, there are three main varieties: fixed rate, floating rate, and inflation-linked bonds. Fixed rate bonds pay the same coupon until maturity. Floating rate and inflation-linked bonds pay a coupon tied to a benchmark like the bank bill swap rate and inflation rate. So as interest rates and inflation fluctuate, so does the coupon on the bond. It might sound a bit like buying shares, but it's quite different. You're considered a creditor and your return is guaranteed as long as the issuer remains solvent. Bonds have a known maturity date where the future value is certain, so the price along the way varies less than shares, which have no known future value. There are two main ways you can directly buy bonds. You can purchase over the counter or via the Australian Securities Exchange. You can also buy bonds indirectly too. For instance, you can invest in a collection of bonds through a bond-themed managed fund or ETF. But in Australia, the over-the-counter market, often referred to as the OTC market, is where 95% of bonds are traded. There are a diverse range of issuers and investors. To buy and sell in the OTC market, you need a fixed income dealer like our sponsor FIG, who enables Australian investors access to bonds and parcels from as low as $10,000. With the ASX, you can invest with just a few $100s, but you'll be limited to a small group of issuers and fewer securities are available. Another option is to invest in ASX-listed hybrid securities. However, they are typically considered higher risk. Whichever option you choose, you should always seek financial advice and consider bonds as part of a diversified investment portfolio. So there it is, what you need to know about investing in bonds in 2023. If you want to open an investment account, or if you're keen to know more after this video, visit the FIG website to find out more. And you can also check out finder.com.au for plenty of articles and guides to bonds and other investments.